Good afternoon, everyone. Thanks for assembling here. Welcome to Karthik, Tarun, and Lakshmi. So very quickly, could I request, starting with Lakshmi, could you give a basic product surface there as to why, how your segment works and why allocating money to your product makes sense?
Good morning, everyone. And rarely do I do a panel which is pre-lunch. So hopefully the eyes and ears both are open this time. And typically on a stage, I am gender minority, which is the case here also. But I am language majority. All three of us are TAMs. I think there is one exception here. So it makes me feel happy sometimes. There is somebody.
I'm married to one.
Oh, yeah. Okay.
So he's more TAM than us.
Oh, really? Okay, so there is a hybrid piece. So on to your point, so before I come directly to the product part of his question, I think I've made a transition from the mutual fund side of the industry to the alternate side of the industry. And having worn both the hats, I was with Kotak AMC for about a little under 24 years. And now a little over 15 months, I've been with Kotak Alternates. There, it's predominantly public debt, public equity strategies, and here it's predominantly private equity strategies, selectively private debt, and of course, public listed equities. I can tell you two distinct differences and deviations. One is if mutual fund is curd rice, Tair Sadam, okay? Alternate world is actually curd rice only, but curd rice with a little bit of, spiked with some crushed ginger, some pomegranate, some, kotamali, with coriander, all of that, and with some nice tadka and some cucumber, all of that. Both belong, the ingredients are the same, which is the underlying investments, but obviously the palate is slightly different. So for example, if you ask me, I am comfortable eating both. But if you ask my father, he will say, what is this, putting cucumber and pomegranate in curd rice? That is not something which I prefer. I like my curd rice just plain with some pickle or urga as they call it in Tamil. So I think that is a fundamental difference between what the public markets offer versus what the private markets offer. And that's what alternates is all about. It allows you to structure certain bespoke solutions, retaining the texture and the nature of the investment. And with that, there is an ability to earn something extra. So there is a plain vanilla debt versus versus a private credit. There is a listed equity versus a structured equity. And the underlying asset class being the same, how do you really modify certain terms to make it beneficial to your advantage? I think that's exactly what the alternates world is all about. And that's exactly what we've been doing in the past. I think the Kotak Alternates platform obviously has been in existence for over 2 decades. And furthering the cause is what I'm doing for the last 16 months at Kotak Alts.
Thank you. Urga before lunch. Thanks for that. So, Karthik, to you, from an investment perspective, right? Anyone who's looking to invest in the alternate side, what is the horizon generally that they should look for in this segment? And give us a flavor of the returns as well.
Okay. So just as Lakshmi introduced the subject, I'll spend 30 seconds. So I heard the morning equity sessions, and I think Anirudh made a couple of fantastic points, as did the other gentleman. But essentially what I absorbed was, I heard 2-3 key things. Business cycles can outlive return cycles is something that I heard. And essentially India is by its very definition a growth market. So as both speakers alluded to in the morning, and we agree. So the majority equity allocation will always be there, towards, listed equities and so on, simply because it's a proxy for what the country is expected to deliver. Now, within that, things like volatility, mark to market, depending on the nature of the investor, and sudden feeling that, whether I'm over allocating to equities or do I have room in my portfolio to do other stuff to sort of balance out, risks, consistency, rewards, is really where the allocation to alternates comes. The other eternal search or reason for allocation to alternates is a search for yield. Now, equities in India has become in many ways a staple. So, you can pick managers, the track records are transparent, it's over a longer period of time. So essentially today, as Lakshmi said, in the last 10 years, from a market that was zero, today we are close to 11 lakh crores and roughly, 20% of the mutual fund industry as an AIF group. So obviously it is pointing to the fact that there is a demand for things other than listed equity, although listed equity will be the mainstay of allocations. We have seen in our own investor base over the last 7 years at Sundaram, investor allocations going up from less than 5% to close to 20% today, purely in credit products, which is what, we do. So we run real estate strategies, we have corporate credit strategies. Recently, we've launched a debt PMS business. And so we've consistently seen our AUMs go up. Today we manage close to 7,000 crores, including PMS equities. So we believe that the horizon that investors look for, while they look at mark to market and shorter term going in and out from an equity standpoint, typically 4 to 5 years is a term that they are okay to look at making this kind of alternative yield. Within that, obviously, from a duration point of view, there are products which range from as low as 1.5 years to as much as 7, 8 years if you go into a private equity structure, simply because that is the nature of how the underlying creates value. At least for Sundaram, what we've been doing is doing a pure credit senior secured strategy where we are consistently able to deliver between 15 and 17% return, which is a very, very strong income compounder from fund to fund over a longer period of time. So that's where we are focused in building diversified senior secured portfolios, which throw up cash every quarter and help an annual compounding of close to 15, 16%. So from a tenor and horizon point of view, as Lakshmi said, there are people who look for portfolios which are bespoke, a 1.5 to 2 years short exit. And otherwise, if they believe that, they are otherwise, fairly well provided for from a cash flow point of view, they want the effect of compounding to happen over a span of 4 to 5 years. That's what we've seen.
Excellent. Thanks, Karthik. Tarun, so how do you see the role of alternate investments evolving here, right? And are there any specific trends? Since you come from the private equity side of things, I'm sure you see quite a few trends that are developing. What are the kind of trends that you see?
So I think, of course, alternate investments are here to stay. It's becoming a larger and larger portion of allocations, and it's coming down the curve. What I mean by that was the initial capital that was being allocated to alternate investments were really global institutions that would be allocating to managers in India. We are starting to see that happen in domestic institutions now. So large banks, insurance companies, even public sector, private sector, across the board, we are starting to see that allocations. The next segment that came in were really large family offices. And at 361, we have a really good servicing of the large 7,000 odd family offices in India, ultra high net worth folks who started meaningfully allocating in private equity. And you see large names like, Manipal Group and so on, who are making serious investments there, even at the fund level or at a individual entity level. And as we are starting to go down that, we will see deeper and deeper penetration. So the capital pool for alternate assets in India will start deepening even more. And on the risk spectrum, if you also start looking at where the trend is moving, there are credit products, of course, there's real estate. And then when you get into unlisted equities, we started with relatively more liquid, less risky products like pre-IPOs. But now we are going down that curve as well, where growth funds are coming in. For instance, at 361, I'm leading a sector-focused, healthcare-focused growth fund, which is just focusing across the subsegments of healthcare. So as people start to get increased allocations, both from an institution and a private wealth perspective, then they are getting more and more sharper about what strategies within alternatives do I like to play. There are people who are very keen on doing early stage tech investments. So we also have a strategy there, which is as early as seed investing or early growth investing. Some people are more comfortable doing secondaries or late stage investing. We have a strategy that services that as well. So people over time will start looking at, thinking sharply about where do I feel my alpha is going to come from where versus the other portions. And that's going to just make the investor pool more sophisticated, more deeper as more and more capital starts flowing in. So I see a lot of the sophistication level improving as we go along.
Thanks. That made a lot of sense. So Lakshmi, over to you, right? So from what you guys spoke, we can see that there is a this segment is growing rapidly in India, right? But what is driving it in India? One question. And before we just walked on the stage, we just spoke about the investor awareness, right? Where the investors are pushing more money in this side. What is the level of awareness do you see? And are the investors actually looking for asset class options?
So two parts to your question, Vignesh. One is that why are people moving towards alternates? One is they think they are fully aware. That is, and that ties into your second question, which I'll come to in a bit. But the most important need is that the need is being felt for diversification. We do agree that there is a need for diversification, but I also maintain that it should not be that diversification should be for the sake of it. But if there is an opportunity, as Tarun rightly mentioned, if there's a healthcare opportunity, now there are two types. We are bullish on pharma. As a firm, we are bullish on pharma. Now, if you look at the listed opportunity space in the pharma healthcare, for example, there are obviously that many only opportunities. But if you go into the unlisted space, for example, you can go into early stage, mid stage, late stage. You can play the entire spectrum. Ditto with consumers. So I'm saying you pick and choose any sector, or for that matter in the credit front. So if you want that additional delta, there is only that much you can do in the listed space, and that is the reason we are seeing very consciously investors looking to diversify into the alternate space, where they are mindful of the risk and they know that, okay, this is what I'm going to allocate. And mind you, these are all long gestation investments. The typical investment mentality in a listed equity or in a mutual fund space is I can put my money today and then I look at the NAV. Before you sleep, the NAV is published on the website, whereas all that is completely utopian in the alternates world. You get the NAV in the unlisted space once in a quarter, if you're very lucky. And of course, in the listed space, you get it every day. That's a different thing. So I think diversification is the one key thing. And with that diversification, your agility and ability to earn that little bit extra. See, I want to take that extra risk only when I know I'm going to make something extra. And that is exactly the reason. And alternates clearly provides that. If you see well-managed credit funds, can deliver 20 to 23% gross yield. I do not know in this maybe next 5 years or 7 years, which bond fund in India will be able to even closely give you that kind of a gross yield. It's next to impossible. So I think that's clearly one of the reasons. On the awareness part, I don't think we are completely there. The ticket size of an AIF is 1 CR. There is no SIP. Of course, you can do top-ups, etc. That's not a problem. We are working with the regulator actively to try get some of these activated. But Rome was not built in a day. So, if mutual funds is actually Amitabh Bachchan in terms of height, AIFs is still Amir Khan in terms of height. So it will still take time to reach that stature. But the point I'm trying to say is it's growing day by day. And if you see the last 5 years, we've compounded at almost 40% growth in terms of incremental commitments. Awareness, I would love to see much, much more. We are trying. We are working with the regulator. We are working with channel partners, stakeholders. Bulk of the money which is coming into AIFs is actually coming in from foreign investors because they love India. They know that India is a land of opportunities. And if they have time, 6, 7, 8 years, there is money to be made. And as we call, the multiple of capital invested, which is MOIC, there is incremental IRR to be generated. It is great to see that there is Indian capital also, which is going and making its way. So you look at private equity funds. The foreign private equity funds now are making beeline into India and they want to raise capital and they are okay with 1,000 crore kind of commitments to start with because they all want to, have a foot in the door. So I think there is no two ways about it that if you take a long rope and you look at the next 10 years, the growth is here to stay. And the growth, because the base is low, the growth can obviously get compounded at a much faster pace, probably where the mutual fund industry was 15 years back.
Excellent. I like that Amitabh Bachchan and Amir Khan. I hope they both perform equally, but anyway, yeah. So before I spice things up with Karthik with some of my favorite pointed questions to him, I'd like to go to Tarun. Tarun, see, the healthcare segment as such in India, right, has evolved over a period of time. Now, are these shifts that you see influencing your investment decisions? And also, there are some clear, visible healthcare, like for example, AI with healthcare, which is picking up, right? And manufacturing, medtech is coming into India, a lot more manufacturing. How do you see these trends? Where do you see this going?
No, absolutely. I think I have been investing in healthcare for like 17, 18 years now. And this is probably the most exciting phase that I have seen of investing in healthcare. Uh, just to take a step back, why we feel, or at least why we started with the concept of raising a healthcare fund at this point, at this time, and especially given that at 361, we have made truckloads of money investing in healthcare at the late stage as well in pre-IPOs and so on. But one thing that was very clear for us is that healthcare continues to be a very happy hunting ground. It's a super growth sector, whereas across the world, it's seen as a very safe and secular growth kind of space. But here, it's still a very high growth sector. Anyone who's interacted with any hospital setting or any healthcare, this thing knows that the incidence of just chronic diseases is just going in one direction. Every generation feels that it is less healthier than the previous generation, and that's happening across the board. So from the demand side, there's no problem. As insurance coverage increases, affordability will also not be a problem in India. As urbanization goes up, access to healthcare will not be a problem in India. So from a growth drivers perspective, it's in a very great space. To your point, the innovation that's happening in healthcare on top of it is continuing to increase year by year. 5-10 years back, we wouldn't have heard of models like standalone dialysis centers or a standalone infertility chains, which are now becoming large and profitable businesses on their own accord. So innovation levels are very high. And thirdly, which is very important for people just starting their journey on the alternative side, is the sector or the companies face almost zero mortality risk. You don't hear of companies, blowing up in the healthcare space. They're not affected by Ukraine wars or interest rate cycles or recessions or anything. Very, very stable business. And hence that gives, for anyone who's considering entering into alternatives, it's a very safe sector to enter in. So now when we start talking about the innovation, to your point, and we are currently doing a deal which is overlapping AI and using it in a radiology setup, that's when the work gets really interesting. And I'll give an example of what it's doing here. If you look at, let's take lung cancer in India, or across the world for that matter, lung cancer gets detected only at a late stage because the radiologist is not able to detect the nodule when the nodule is just starting to form, which means 80% cancers get detected at stage 3, at which there's only 17% survival rate. So what this company that we're investing in is doing is that it has software which is trained on something like 1.3 billion images, which is able to detect it at an early stage, which is the only US FDA certified software product in the market. And the pharma companies love that because for a pharma company, every patient that you get for cancer generates a revenue of $300,000, all reimbursed by the insurance companies. The patient obviously benefits, the hospital benefits. So now the pharma companies and hospitals are taking this product out and rolling it out in all their X-ray machines across their hospital networks. And this is not a young company doing $1 million in revenues. This is a company doing more than 300 crores of revenues at a global level. So those are the opportunities that we see are now coming out. This is an entrepreneur who's a junior of mine from school, but he's an entrepreneur was a chief data scientist in an analytics company, left that firm, set up this business, has got the best in breed clients they work with, has got the global regulatory approvals in place, and is generating revenue of that size. So the innovation journey in India is just starting. We are seeing very, very exciting place, but not very early, but still at a stage where we know that we'll be able to generate returns in the next 3 to 4 years. So yeah, I can talk till the cows come home on healthcare, but that's where the excitement is coming from. And it's across spaces. In diagnostics, we see it in life sciences and pharma. We're seeing in single specialties, in devices across the board.
Excellent. So Karthik, considering this, right, see the private equity segment doing well. A real estate fund is a really long gestation period investment, right? And it's very cyclical, right? You have issues like how 2016 to 18 happened. How do you protect the interest of investors here, right? And do you think the standards of risk management and scrutiny have gone up to be better now?
Okay, before I answer that, I'm so tempted to still go back to what Lakshmi said. She's in a privileged position to be Amitabh Bachchan's stature with Kotak.
Yeah.
That's why she's getting billions of dollars from offshore investors. But a predominant part of the flows in the AIFs do come from the domestic market.
From Amir Khan.
From Amir Khan. and we are all recipients of Amir Khan and so on and so forth. So a majority of the asset allocation I refer to in answer to my first question are from domestic investors, just for this audience, because they shouldn't think that, it's an offshore somewhere, dur ki baat hai. So it is essentially all domestic investors who are massively increasing allocations towards alternates. Now, coming to your question, first fallacy is to think that real estate is a long-term investment. It's not. So, in fact, just by way of track record, while our real estate credit funds are 5 years, essentially, we return both the entire capital in less than 3 years. Okay. And increasingly, all of our deals are prepaying. We have 70%.
But that is in a good cycle, right?
No. It's not a good. So we started in 2017 when the fag end of demonetization. Then we had RERA, which was short-term pain, long-term good. Partially answers your question as well. Then we had the GST working capital issue. We had NBFC crisis, 2 COVID waves, a hyperinflation. So we've seen every macro impact adverse credit event. And so we consistently found that, obviously there are, real estate is a very wide space. And so it is very important for an investor.
Did you say white space?
WIDE. So
I thought there's a lot of black.
So essentially, also incidentally, by the way, majorly white at the moment. But point is that there is a wide WIDE range of risk that you can take. When you manage a real estate fund, you can structure an investment as a debenture, but you can end up taking equity risk. You can go in and buy land. You can go in and do a takeout. You can put money away from the projects that, are supposed to give you your money back. So there's a whole bunch of things which make it very easy for a manager to get attracted by yield and go and take equity, quasi-equity risks, right? So this is not just true, by the way, of real estate. This is true by and large of all strategies, but more so in real estate because money is very, very fungible. Institutionally and sector-wise, RERA has made a massive difference in terms of increasing hygiene levels in the industry, where although most of the developers, fought and moaned and so on for the first few years, now RERA is here to stay, and there is a significant amount of corporate governance in terms of cash not going out of your project as a customer. Being accountable, sticking to deadlines, delivery versus penalties. So there's a whole range of adverse consequences to bad behavior, which has largely corporatized the sector. That has massively helped managers to manage risk at a sector level. Now, at a fund level and at a deal level, obviously it depends on the micro strategy that any person has. And at Sundaram, we've consistently from day one to date, done more than 52 transactions, deployed 3,000 plus crores purely in a senior secured credit model. So effectively, we underwrite at very high, covers, low LTVs. We do cash back. We only enter brownfield. We have multiple pools of cash flow, different projects backing every single investment. So we've chosen to go the very conservative way. While, I have worthy competitors in the market who've decided, understandably so, to take equity risks. So they'll come in and help buy land, take development risk, take back-ended sort of repayments, push the risk down the road, and so on and so forth. So for them, it would appear like a longer gestation investment or fund life versus us, where, we're already sitting and saying that in a 5-year fund, we're actually returning capital with well over hurdle at 3 to 3.5 years. So it depends on how you structure, and it's not generic, as a necessity that you have to take a very long-term risk. And I don't want to go into significant nuances, but plotted developments, which are really the fancy in Chennai and Bangalore, for example, right now, have a project gestation of 1.5 years, right? So, you can actually churn, if you build your fund around a plotted strategy, in a 5-year period, you can churn your fund 3 times. Imagine the multiple of invested capital you can create with a 20% return on fund after fund after, or cycle after cycle of churning, right? I mean, so you can actually hit private equity multiples, if you churn capital fast. So there's all sorts of possibilities from an asset-backed strategy, and particularly real estate. So I would say that it depends to a large extent on the due diligence that you guys do and help your investors do in terms of assessing what is the cultural behavior, the core strategy, how an asset and cash flow is expected to perform before you get committed to a fund or advise clients to commit to a fund. And of course, it can be a long gestation strategy as well. I mean, there's a classic argument from 2017 to 19 I faced whenever I went to pitch. I'd rather buy a flat in Juhu, particularly true of Mumbai investors who think
that's my next question.
and they want, Mumbai is the center of the universe, right? I mean, just as people in New York think it's the center of the world. So effectively now it has shown that from a capital appreciation point of view, particularly with indexation going and so on and so forth, it is a very, very big trend for people to move away from physical assets to fiscal assets. So it is happening in our space, where people earlier who thought of credit concentrating or asset concentrating on a 25 crore flat are choosing to give money into a fund which builds a diversified portfolio and generates a risk-adjusted return which is beating the capital appreciation that they could have got. So that's a long answer to your question, but I hope I answered and didn't meander so much.
So J Real Estate, thanks. So Lakshmi, now coming back to you, right? So we spoke about private equity, we spoke about real estate, and you touched upon private credit also, right? How does one diversify portfolio amongst these kind of offerings? Let's include me, venture capital. So how does one diversify the portfolio level?
I would say all these are four in a box. And you have your financial assets, which is like 100 rupees of your portfolio. And there has to be I would say a compartment for maybe up to 20%. And that 20% should comprise each of these four strategies. That's the way I'd put it, because alternates, is where it's extremely potent in terms of its return generation capability, whether it's in the healthcare, whether it's in the real estate, whether it's in the VC, very early stage. Spot them young, watch them grow. You say that for the mid markets or the small cap segment. You say that for the VC segment also in alternates. So it's not that it's, listed is in Mars and, the alternate space is rest of Mars, or, listed is in Earth. So that's not the way. So I would say alternates, can it be integral? Can it be core to the portfolio? Maybe 70-80% of it? Probably not, because irrespective of all that we are all discussing today, it still has longer gestation compared to listed markets. It still has the time taken to be able to bloom and blossom. So you are investing at the caterpillar stage and waiting for it to blossom into a butterfly. Quite a bit of it. And of course, some of them are in the cusp of that, in that mid part of it, and then it blossoms kind of a thing. So therefore, I think up to 20% allocation to alternates is a great, opportunity. And how much of that you need to go into a VC, into a sectoral theme, into RE, into private credit, all of that is a function of your and only your risk appetite. If you believe that you want returns, gestational every 6 months, every 12 months, none of these asset classes are going to gratify you. None of these asset classes are going to woo you. So I think some of these things you really need to keep in mind. There have been structures, by the way, as Karthik made a very valid point, there have been structures where we've called the shots, providing a solution capital to companies which are in, dire states, requirement for capital, not in bankrupt stage, by the way. So good performing kind of credit, a little bit stretched on balance sheet, providing a solution capital, they repay you in 1 year. And that repayment of 1 year comes with an IRR of in excess of sometimes 18, 19, 20%. So I think these are opportunistic bets which the listed markets may or may not really be able to find, an opportunity. Keep it as a tail end portion of your portfolio. Can you have a dessert? Do you like chakra pongal? What do you like? I don't know what you
Ven
like.
pongal.
Ven pongal. I love chakra pongal. So can you have that for breakfast, lunch and dinner? Maybe if I come to Chennai once in 6 months, I don't mind having it for breakfast, but you can't have it, breakfast, lunch and dinner, because the risk of diabetes obviously will shoot up. So keep these as pairing portions of your portfolio, but integral it has to be. So today, on a broad brush, I don't even want to do a poll in the room. Intuitively, I can guess that not too many people are invested in the alternate space. But looking at the last 5 to 7 years data, it's clearly evident that the proliferation of funds being offered and the investors coming into this fold is only growing. And that is where we believe that, alternates are going to be a mainstay in each of your investment portfolios.
Thank you. The answer. So, Tarun, I'm going to double flip it for you with the last question. So, one, how do you look at exit strategies for healthcare investments? Because like you said, it's still nascent. The technology getting built in, the opportunities are coming in. How do you look at exits in your segment? And a common question for all of you, which you can also answer, is how challenging is it to source good deals in India in this space?
On the exit side, I think it's one of the jobs we are in, that when we invest in a company at that time, from day zero, we have to start thinking about exits. And the plan for exits is very company and deal specific. But one thing I'll say, and I referred to this earlier, is that on the exit side, the market for healthcare has steadily come to a point where it's super, super attractive right now. Last year, healthcare delivered something around $2.5 to $3.5 billion of exits for investors. And more importantly, what we are seeing is that if you would have asked me this question 10 years back, I would have said either there's an IPO option or somebody will come and buy your stake. But now the exit opportunities have really expanded in healthcare, for instance. Large buyout funds are looking at Indian scaled up healthcare assets, and they've done deals. You name it, Blackstone has done it, KKR has done it. All these large guys are doing very active buyouts. Again, last year, buyouts in healthcare were the second largest segment within the buyout space. There are very large sovereign funds that are looking again at scaled up investment healthcare assets. GIC, Temasek, RDR, CPPIB, they have done investments both in hospitals as well as in pharma players. That is only going to expand from here. We also see large family offices. Premji Invest, as an example, has a very big healthcare investing practice. So for us, as we invest at the growth stage and the companies scale up, of course, we have options of taking them IPO, and the public markets are giving very attractive multiples. But there are these additional parts of capital that have opened up over the last 4 or 5 years that is making the exitability of healthcare assets very, very strong. So what our model ends up being that if, let's take a hospital trades at a 25x EV EBITDA multiple and the IPO or at a late stage, we try and enter it at anywhere between 10 to 15x EV EBITDA. So we get a meaningful valuation discount at the growth stage when we enter, because that stage it's not super competitive. And the companies, of course, have not grown that much. So we discount their performance risk that we take at that point. We come in at that, we are able to underwrite somewhere between a 35 to 40% year-on-year growth. So for that asset, the IRR that we target is in the early 30s. And that's the way we typically end up building a portfolio around it. And when we think about exit, a lot of it has to do with the promoter engagement at the outset, which is what is the path that the promoter feels we should be taking. I have said no to so many deals where the path that the promoter wanted of exit, I just didn't feel it was a viable path. At 100 crore EBITDA, if they want to do an IPO, it's not going to happen. So lots of time that alignment needs to happen if the promoter is comfortable with the strategic sale down the line. And if I feel that's the path that the company can take, or there are a lot of acquirers in that space, that's the kind of engagement we end up doing. So it's a horses for courses, to be honest. But a lot of our underwriting on exit happens right at the outset and thinking about it.
And what sourcing?
Sourcing for us, to be honest, it's not a problem. And I'm not being bragging here, but it just helps that you've been in the market for 17, 18 years. You know all the usual suspects. We know all the board members, co-investors, all the serial entrepreneurs that are out there. But 361 has a particular advantage, and which is that thanks to our wealth network, we have 7,000 odd families that we are closely in touch with through our relationship managers. And a lot of the deals that come up are the ones that come through them, because our relationship managers have a connect with them that is much better than any investment banker has. So if any of those companies, their subsidiaries, their portfolio companies where they may have done investments are coming up, we get to see those companies. So in addition to that, we also have a fund of fund strategies within 361. So we are LPs in a lot of the early stage funds, like the Bloom, the Orias, and so on. So as LPs there, we access to a lot of their deals. We see the entrepreneurs, we know the companies well. So we are able to move in quickly and invest in the ones that are breaking out ahead of time. So from a deal access perspective, to be honest, it's a very comfortable spot for us. And the last thing there is that, we did some math. We almost 85 to 90% of deals that happen in the market, we have seen them. So we have strong access in an Indian market.
So I'll keep it short. So what we do from an exit standpoint is because we are 100% credit, we are not market correlated from an exit standpoint. So we are self-liquidating deals, and close to 90% of our exits happen from projects that we have financed, whether it's on the real estate side, corporate credit side, or so on. From a deal sourcing point of view, when new entrants, although with a 100-year-old pedigree from Sundaram, we are the youngest of the companies. But over the last 6-7 years, we've developed a fairly robust sourcing mechanism. So I don't think availability of deals or demand for alternate credit is the issue. I think the market is on an annual basis 60 to 70,000 crores of credit demand, which we cater to amongst others. However, I think the only thing that as managers we have to worry about, not just us but others as well, is in the urge to scale. If there is a set of managers or funds who are coming in and pricing things differently from what the market is doing, then I think there is a possibility of too much money chasing too few deals or the same deals. So that's something which is generic in most financial services businesses, and it's not unique. But some of that might be happening in the alternate credit as the industry is in its very early stage of growth. But that's par for the course. So I think what we are looking to do is to manage all of this and continue to grow, which is sort of what we are doing.
I think very similar to what Tarun and Karthik spoke. See, exits in listed world is that, you go click a button on the exchange and your exit is done. It's not that simple over here, but that doesn't mean exits don't happen. In the last 20 years of existence, we've returned billions of dollars of monies, ranging from real estate, private equity, listed equity also is there, but listed equity is, available to sell on the exchange, infrastructure credit, all of that, where you need to plan in two ways. One is that the moment your deployment is done, you actually start planning for exits. It can happen through buyout funds. It could happen through another private equity fund. It could happen through large family offices, all of that. And there's a demonstrated track record across the industry. So I don't think exit is so much of a challenge. There is pockets of, I would say, exuberance when everybody is a seller, or everybody is a buyer, but that happens in mid-markets, listed equity space also all the time. So I don't think that's a challenge. In terms of opportunities, again, one needs to be very selective. Growth at a reasonable price versus growth at any price. I think that is a fundamental difference which demarcates the kind of opportunities. So this is a market where, you need to have the Varmala or the garland, and you need to go and do your Swayamvar and need to be picky and choosy about who you want to garland it. Because once he or she is your spouse, that spouse has to be for keeps. Of course, in the investment world, you have the luxury of having multiple spouses. That's the only feel-good factor. But you need to be picky and choosy about what you want. So if you remember in Mahabharata, Draupadi said she wanted A, B, C, D, E, and that's how she said that she got kind of, wedded to the Pancha Pandavas, because that one quality was not there in that. So I think that's the way we, approach investments. So exits, it's not easy, but it's not difficult or impossible. You need to plan for it. So we have a late stage growth fund where it's almost fully deployed, close to 2,000 crores. The fund maturity is in 2026. We've already started planning for exits. So that's the way you need. You really need to approach it. Likewise in private credit, the structure is made in such a way, self-liquidating, whether it's cash flow driven, whether it's a put option, whether it's a compulsory convertible structure. Each of that are embedded. So structuring is very, very critical, whether you're doing on the alternate space on the credit side or for that matter on the equity side.
Excellent. I think we're out of time. You guys have been excellent panelists. Thank you. Thanks a lot.